Welcome to Finance Deep Dive. All right, today we're jumping into one of the biggest questions every single investor has to answer. Do you go it alone or do you run with the pack? I mean, your entire game plan, it really starts right here. Okay, let's put you in the driver's seat. Imagine this. You've got $1,000 ready to invest. What's the move? Do you put all your chips on one single company that you think is going to be huge? Or do you spread it out and buy a little slice of the entire market? This single choice really boils down to two very different investment philosophies. In one corner, you've got the lone wolf. That's the individual stock picker, always on the hunt for that one massive game-changing win. And in the other corner, you have the pack, the ETF investor who finds strength and safety in numbers, moving with the market itself. So let's kick things off with the lone wolf. What is it about going it alone that's so tempting? I mean, why do so many people get drawn to this high-stakes path? Oh, it's all about the dream, isn't it? It's that adrenaline rush, the thrill of the hunt. It's the fantasy of finding the next Apple, the next Amazon, when it's just a tiny startup and riding that wave all the way to a life-changing payday. But then reality hits, and it hits hard. Check this out. This is a quote from Jeff Bezos himself, the founder of Amazon. He basically said that one day, even Amazon could go belly up. Now think about that. If Amazon isn't a forever bet, what company possibly is? See, picking individual stocks isn't just a numbers game. It's a total psychological battlefield. When you're a lone wolf, it's just you against your own worst instincts. Greed screams at you to buy at the peak, and gut-wrenching fear tells you to sell everything at the bottom. It's a brutal roller coaster. And this gets to a really key concept, uncompensated risk. That's a fancy way of saying you're taking on a huge amount of risk without any promise of a huge reward. I mean, history is basically a graveyard of companies that were once considered can't-miss investments. Anybody remember pouring money into Sears, Yahoo, or AOL? Yeah, exactly. All right, so that's the high-risk, high-reward world of the lone wolf. But what about the other side of the coin? Let's talk about the power of the pack. What's the big deal about investing with the crowd? So, first things first, what in the world is an ETF? Well, the easiest way to think about it is like a shopping basket. Instead of buying one apple, you buy the whole basket. And inside, you get a little bit of everything. In investing terms, you buy one share of an ETF and bam, you instantly own a tiny piece of hundreds, sometimes thousands of different companies. And here's my favorite way to explain it. Picking a single stock, that's like betting all your money on one single runner in a marathon. They could be a superstar, sure, but they could also trip and fall. Investing in an ETF, that's like betting on the entire marathon. Some runners will get tired, but the race as a whole keeps moving toward the finish line. And just so you know, we're not talking about some small niche idea here. The global market for ETFs is worth, get this, $14.7 trillion. That's trillion with a T. It's an absolute powerhouse, and it shows you where a huge amount of money is flowing these days. So what are the pack's big strengths? Well, let's just run through them. You get instant diversification, which means your risk is way lower. It's super low effort, you don't have to watch it every second, and the costs are generally rock bottom. The whole idea is beautifully simple. Stop trying to beat the market, just be the market. Okay. We've met our two contenders, so now it's time for the main event. Let's put them head-to-head in a direct showdown. Lone wolf versus the pack. First round, diversification and risk. And honestly, this one's a knockout. A single stock is all your eggs in one basket. Super low diversification, which means super high risk. An ETF, on the other hand, is a whole bunch of baskets. Your risk is spread way out. Next up, management and cost. Being a stock picker is like a part-time job. You need to do constant research. ETFs, they're pretty much set it and forget it. As for costs, with stocks, you're paying commissions to buy and sell. With an ETF, you typically pay a tiny annual fee called an expense ratio. But hold on, there's one more factor here, a hidden cost that can be an absolute monster, a silent killer of your returns that almost nobody talks about. Yep, I'm talking about taxes. Now, check out this chart. The takeaway is huge. Because of how they're built, ETFs are ridiculously tax efficient. In 2024, only about 5% of ETFs had to pass on a tax bill to their investors. Compare that to traditional mutual funds, where 43% did. That is a massive difference, and it means more of your money stays in your pocket. By the way, if you're finding this useful, do me a quick favor and hit that subscribe button. It honestly makes a huge difference and keeps us fired up to make more of these for you. Okay, so we've laid it all out there. We've seen the fight. Now for the million-dollar question. How do you choose your path? And here's the real secret. The answer isn't about which one is better in a vacuum. It's not about stocks versus ETFs. It's about you. It's about being honest with yourself about your goals, your personality, and how much risk you can actually stomach when things get choppy. So, who should be a lone wolf? Well, this path might be for you if you genuinely love digging into company reports, if you have a stomach of steel for big ups and downs, if you want to be 100% in control, and, this is the big one, if you have the ironclad discipline to not freak out and sell at the worst possible time. And who should run with the pack? This is probably your jam if you're just starting out, if you'd rather have a more hands-off, set it and forget it style, or if your main goal is just to grow your money with the overall market, not to try and be the next Wall Street genius. But hey, remember this. This isn't a black and white decision. You don't have to pick just one. A really popular strategy is to do both. You build a solid foundation with a bunch of low-cost ETFs, and then you can use a smaller amount of money to pick a few individual stocks on the side. Best of both worlds. So that brings us right back to the beginning, but now it's a question for you to answer. After hearing all this, what kind of investor are you? Are you a lone wolf, ready for the hunt, or do you find your strength running with the pack? And if you liked this content, don't forget to subscribe. It really motivates us to keep posting.